Welcome to Application Analysis, the Property, with your host, me, Joseph J. White. In this tutorial, we will be covering the following topics. 1. Appraisal Basics. We'll be looking at the Appraiser, Accreditations, the Appraisal, and valuing a property. In Section 2, we'll be looking at calculating the market value. And in Section 3, we'll be looking at types of appraisals. The desktop appraisal, drive-by appraisal, and full appraisal. Once you've completed the tutorial, it will be time to move on to the interactive quiz. So, let's get started. Introduction. A real estate appraisal is a key component in a lender's decision to lend. There are several purposes for completing a real estate appraisal, including to determine the cost to rebuild the home in case of damage, such as by fire, which is the insurable value, a value so that a municipality can apply its property tax rate, so this is for taxation purposes, the price that a real estate investor would pay for a property based on his or her preferred rate of return, or investment value, the amount that the property can obtain if sold, the selling price, the future value of a property under construction, the future price, the value of a property being expropriated by the Crown, which is the expropriation value, or the market value of a property for a lender to decide on an appropriate loan amount for mortgage financing. The process in determining value for each reason differs, since the value will differ based on the appraisal's purpose. This module will focus on the appraisal process only as it relates to mortgage financing. Section 1, Appraisal Basics, the Appraiser. A lender requires an appraisal to be completed on a property to determine the market value of that property. In addition, an appraisal can provide several other pieces of vital information required to make an informed decision to lend. Since lenders will lend based on a loan-to-value, the lender requires an exact estimation of value to determine the exact mortgage available. Now let's have a look at some of the accreditations that appraisers can obtain. There are several accreditations provided by professional associations, each granting its own designation. The most widely known and accepted designations are offered by the Appraisal Institute of Canada, a professional appraisal association. The AIC provides two designations, the AACI and the CRA. Both designations have educational requirements, such as a university degree, as well as experience and continuing education requirements. The AACI PAP, or Accredited Appraiser Canadian Institute Professional Appraiser, is the highest designation provided by the AIC. This designation certifies that the holder is qualified to offer valuation and consulting services on all types of properties, including residential, industrial, commercial, and rural. The designee holds an undergraduate degree from a recognized university and has completed the AACI program of studies and has fulfilled all of the professional requirements of the AIC. The CRA, or Canadian Residential Appraiser designation, is an individual who holds an undergraduate degree from a recognized university and has completed the AACI program of studies and has fulfilled all of the professional requirements of the AIC. The CRA is qualified to offer valuation and consulting services and expertise for individual, undeveloped residential dwelling sites and dwellings containing not more than 4 self-contained family housing units. There are also other designations available. For a description of those designations, please refer to the course manual. Now let's have a look at the appraisal. An appraisal is a report produced by a designated appraiser that determines the market value of an interest in land using accepted valuation techniques based on the purpose of the appraisal for a specific client. The client in most cases of mortgage financing is the lender, although the applicant typically pays for the appraisal report. It is an important distinction to make that the client is paying for the service of the appraisal being completed, while the lender owns the report. The report will base the market value on the lender's specific criteria and include details about the property that the lender may require. In certain circumstances, lenders will require a different emphasis on property characteristics, resulting in the appraisal report being acceptable to one lender while unacceptable to another. If a lender declines the applicant's request for financing and the applicant wishes to provide the appraisal to another lender, the appraiser must readdress the appraisal to the new lender, and the new lender must be willing to accept it. This does not always occur since different lenders have different requirements. Valuing a property. It is important to distinguish between market value and price. Price is what may be paid for a property. However, there are many reasons that the price paid for a property may be higher or lower than what someone else may pay for it. For example, if a purchaser is buying a house from a family member, the price paid may be lower than the price would be if sold to a non-family member. In addition, a real estate investor may pay more for a property that he or she believes will provide a high return on his or her investment. Section 2. Calculating the market value. The income approach. The income approach of appraisal calculates the value of income-producing properties, such as apartment buildings and other commercial properties. This method takes the net operating income that is generated by the property and applies a capitalization rate, or a rate of return typical for the area, to that income. The result is the property's market value. While this process is ideal for income-producing properties, it holds no value in determining the market value of a residential property for mortgage financing. The cost approach. The cost approach of appraisal calculates the value of a property based on the cost of replacing it. This method takes the cost of rebuilding the structure, less depreciation, plus the cost of the land, resulting in a final value. The value produced by this method is ideal for determining the cost of replacing a building for insurance purposes, but holds little value in determining the market value of a residential property for mortgage financing. This method is included in a typical residential appraisal to illustrate the cost of replacing the property and assist in determining the market value. However, it is not heavily relied upon in making the final valuation of market value. The direct comparison approach. This approach in determining the market value of a property is the most appropriate for mortgage financing and is therefore relied heavily upon in the appraisal report. This method uses the principles of substitution as its basis. The concept is that if an appraiser knows the price that was paid for a comparable property that is similar to the subject property and has recently sold in the same neighborhood as the subject property should have a market value equal to that comparable property. This method would be simple if not for the fact that properties are heterogeneous or unique. While two houses may be located next to each other on the same street, each will have differences, from its size to such characteristics as a finished basement, the number of bedrooms and washrooms, the type of heating, appliances, and so on. Calculating the market value. Example. A two-bedroom, two-story home was recently sold for $400,000. An appraiser is being asked to appraise the house next to it for mortgage financing. The homeowner feels that, as the property next door sold for $400,000, his home should be worth more since he has a larger backyard. The appraiser, while using the recently sold house next door as a comparable property, must use two other properties that are similar to the subject and have recently sold. In this case, the appraiser will determine the characteristics of the comparable property and compare them to the subject property and adjust the value of the comparable property to make it more like the subject property. Once this has been completed, the adjusted value of the comparable property should be approximately equal to the market value of the subject property. The following chart provides an example as to how this calculation is completed. In the left column are the characteristics of the properties. In the column to the right is the description of the subject property. The far column describes the comparable property and lists the adjustments to the value necessary to make the comparable property more like the subject property. If the comparable characteristic is superior to the subject, subtract from the comparable property's value. If the comparable characteristic is inferior to the subject, add to the comparable property's value. In calculating the adjusted value, the appraisal will add the total adjustments and either add or subtract from the sale price of the comparable property. In this example, the adjustment equals minus $15,000, which is $5,000 minus $20,000 plus $5,000 minus $5,000, and is therefore subtracted from the sale price of $400,000, resulting in an adjusted value of $385,000. Therefore, based on this simplified example, the market value of the subject property should be $385,000. In an actual appraisal, the appraiser will use three comparable properties and will either average the adjusted values or rely more heavily on the most similar property to determine the market value. Section 3. Types of appraisals. Desktop appraisal. The desktop appraisal is typically used when an AVM is unavailable and the property is located in a marketable area. This report relies on MLS reports, including data on recent sales and data on recent listings. It does not provide detailed information on the property, nor is there a physical inspection of the property, which raises the same issues as are applicable to AVMs. Now let's have a look at a drive-by appraisal. This type of appraisal is based on the same information as the desktop appraisal. However, it also includes an inspection of the exterior of the property. While AVMs and desktop appraisals cannot provide details on whether the property is actually in a physical condition normal for the neighborhood, a drive-by appraisal can at least indicate that the property's exterior is typical or conforms to the neighborhood. In addition, the drive-by appraisal allows the appraiser to view and provide details on the neighborhood, which is a key element in assessing the marketability of the subject property. The report typically contains exterior photographs of the property as well as the immediate neighborhood. If the drive-by appraisal results in the determination that the property appears to be in a condition that is not typical of the neighborhood, a full appraisal should be completed. Figure 1 in your manual is an example of a drive-by appraisal report. Now let's have a look at a full appraisal. A full appraisal expands on the information and techniques used in the sales data appraisal and the drive-by appraisal by having a full inspection of the subject property completed. This inspection allows the appraiser to document the characteristics of the subject property, including any upgrades or defects in the home. The report typically contains interior and exterior photographs of the property, as well as the immediate neighborhood. Considered to offer the most information and therefore the highest level of protection for the lender, the full appraisal is the appraisal of choice for lenders who rely heavily on the property as security and less on the personal covenant of the borrower. Virtually every subprime and private lender will insist on a full appraisal. Figure 2 in your manual is an example of a drive-by appraisal report. And that brings us to the end of this module. Your next step is to ensure that you read the chapter in your textbook and complete the chapter review questions. The answers to those questions are at www.remic.ca.